Most people think a safe portfolio is one that looks calm on normal days, but real safety is tested on abnormal days. A fragile portfolio needs the world to stay predictable. An anti-fragile portfolio is built for surprises. It does not depend on perfect forecasts. It depends on structure, cash, discipline, and the ability to act when everyone else is forced to react. The real danger during a crash is not the red chart. The real danger is being forced to sell when prices are terrible. If your rent, debt payment, medical bill, or business expense depends on selling assets at the worst moment, the market owns your decisions. Anti-fragility starts with removing that pressure. Cash is not dead money when it gives you the freedom to wait.
A practical anti-fragile portfolio begins with 3 buckets. Bucket 1 is survival cash, money that protects your life. Bucket 2 is core assets, the long-term engine you do not want to disturb. Bucket 3 is chaos opportunities, money reserved for extreme discounts, career pivots, business ideas, or strategic risks. Without buckets, every dollar feels the same. With buckets, every dollar has a mission. For global investors, a practical starting point is 6 to 12 months of essential expenses in liquid cash or cash equivalents. Not your dream lifestyle, essential expenses. Rent, food, insurance, debt minimums, family obligations, and basic utilities. This bucket is boring on purpose. Its job is not to beat inflation every month. Its job is to stop a temporary crisis from becoming a permanent financial injury.
The core of the portfolio should not be exciting. It should be durable. For many people, this means globally diversified, broad market exposure, reasonable fixed income, cash reserves, and real productive skills. The exact mix depends on age, income, risk tolerance, tax rules, and country. But the principle is universal. Your core should be something you can hold through ugly headlines without needing courage every morning. Chaos money is not random gambling. It is a pre-planned pool for moments when panic creates unfair prices. This bucket can be small, even 5 to 10% for many investors, but it must have rules. What will you buy? At what discount? How much will you deploy? What will make you stop? If you make these decisions during panic, fear will write the plan for you.
Before you chase upside, audit fragility. List every place where one shock could hurt you badly. One employer, one customer, one currency, one property, one platform, one asset class, one country, one giant monthly payment. Fragility hides in concentration and obligation. The goal is not to remove all risk. The goal is to remove risks that can knock you out of the game. Many portfolios look diversified because they own many things. But during stress, assets that seemed different can move together. Growth stocks, crypto, venture funds, speculative real estate, and high-risk private deals may all depend on cheap money and confidence. Anti-fragility asks a harder question. What happens to each holding if liquidity disappears, rates jump, or fear spreads globally? Liquidity is not just how much cash you have, it is when you can access it. Build a liquidity ladder. Money for this month should be instantly available. Money for the next few months should be stable. Money for longer reserves can sit in safer yield options if appropriate in your country. This prevents one mistake: locking up emergency money in something that cannot be sold when life gets messy.
Dry powder becomes powerful only when it has rules. For example, an investor might decide before a crisis to deploy a portion of cash after broad markets fall 10%, another portion after 20%, and another after 30%. This is not a prediction, it is a behavior system. The goal is to avoid freezing at the bottom or spending all your cash too early. One anti-fragile structure is the barbell. Most of your life stays protected. Cash, core assets, stable habits, low debt. A smaller part is exposed to high upside experiments, new skills, side income, business ideas, carefully sized innovation exposure. The mistake is putting your survival money into your experiment bucket. The power is taking small risks that cannot destroy you, but can meaningfully change your future. Convexity means the downside is limited, but the upside can surprise you. In real life, this may look like learning a valuable AI skill, building a small online asset, buying quality assets during panic, or testing a side business with a fixed budget. The key phrase is fixed budget. If the bet fails, you survive. If it works, it opens a door.
A portfolio is not only investments. Your income is part of your portfolio. If one paycheck funds your entire life, you are exposed to one decision by one employer. Anti-fragility means building extra cash flow capacity before you desperately need it. Freelance skills, consulting, digital products, rental income, dividends, or a small business can all reduce dependency. The first goal is not to get rich. The first goal is to become harder to corner. For a global audience, one hidden fragility is having your income, savings, home, and investments all tied to one country and one currency. If your local currency weakens or your domestic economy slows, the damage can be concentrated. Depending on your situation, global exposure and USD-based planning can add resilience. The point is not to abandon your home market. The point is to avoid having every door locked by the same key. Debt can be useful when it is controlled, productive, and affordable. But high-interest debt is usually a fragility multiplier. It turns time against you. During chaos, your assets may fall, your income may drop, but your payments still arrive on schedule. A practical anti-fragile move is to attack expensive debt before chasing complex strategies. Reducing fixed obligations increases your freedom faster than most people expect. Rebalancing is one of the most practical ways to behave differently from the crowd. When one asset becomes too large, you trim it back. When quality assets fall below your target, you add according to rules. This feels uncomfortable because it often means selling what feels safe and buying what feels scary. But anti-fragility is not about comfort. It is about repeatable behavior under stress. Do not wait for a crash to decide what you wish you understood. Build a crisis watch list now. Include assets, skills, businesses, or opportunities you would want if prices became attractive. Write down why you want them, what risks matter, and what price or condition would make you act. A watch list converts chaos into a shopping list. Without it, chaos becomes noise. The most ignored anti-fragile asset is your ability to earn. In a chaotic economy, skills can reprice faster than portfolios. If you can sell, build, write, analyze, code, manage, teach, or use AI tools effectively, you have optionality. Your investment account may go down for a season, but your earning power can keep expanding. In a crisis, the person with adaptable skills is never fully trapped. One practical rule can save years of damage. Never make a major portfolio decision in the first emotional wave. Use a 24-hour panic rule. Step away, check your cash runway, check your allocation, check whether your thesis changed or only the price changed. Panic wants speed. Good decisions often need space. Anti-fragile investors build pauses into the system. The anti-fragile portfolio is not a magic list of assets. It is a playbook. Cash to avoid forced selling, a durable core to stay invested, dry powder to act during fear, rules to rebalance, skills to increase income, a watch list to turn panic into opportunity. You cannot control global chaos, but you can design a financial life that is not destroyed by it, and sometimes becomes stronger because of it.